Have you ever faced a financial emergency and realized you weren't prepared? Perhaps a car broke down unexpectedly, a medical bill appeared, or you lost part of your income. Most people think that simply saving a few months of expenses in a bank account is enough. But traditional emergency fund advice often leaves you vulnerable to inflation, access delays, or unexpected emergencies. In this video, we'll break down the real rules for building an emergency fund that works. You'll learn how to calculate the right amount, where to keep it, what counts as an emergency, and how to replenish it quickly. These strategies ensure your safety net is robust, accessible, and doesn't erode your long-term wealth. 1. Build a bimodal tiered structure. The first step to creating a reliable emergency fund is establishing a bimodal, tiered structure. Many people make the mistake of keeping all their savings in one account, often a traditional checking or savings account that earns almost no interest. This approach exposes your funds to inflation and reduces purchasing power over time. To avoid this, split your emergency fund into 2 tiers. Tier 1 should contain a small, instantly accessible amount, typically 1 month of expenses, or around $2,000, for immediate emergencies like a broken appliance or short-term medical expense. Tier 2 holds a remainder, usually 3 to 5 months of essential expenses, but it should be placed in a slightly higher yield account, such as rolling short-term U.S. Treasury bills or a stable money market fund. This structure ensures you have immediate liquidity while also earning returns on the bulk of your emergency savings, protecting your wealth and maintaining financial flexibility. 2. Base your fund on core survival burn rate. Many people calculate their emergency fund based on lifestyle spending rather than survival needs, which slows accumulation and ties up unnecessary cash. Instead, determine your core survival burn rate by stripping away all non-essential expenditures, such as subscriptions, entertainment, dining out, or luxury purchases. Focus solely on essentials like rent or mortgage, utilities, groceries, insurance, and transportation. By using this lean baseline, you create a realistic and achievable target for your emergency fund, allowing you to complete it faster while freeing surplus funds for investing or wealth-building activities. This method also prevents oversaving, which can unintentionally limit compounding growth over time. 3. Conduct a biannual liquidity stress test. Simply building a fund is not enough if access to it is uncertain. Many people assume their emergency savings are accessible, only to discover limitations when they actually need the cash. Banks may restrict ATM withdrawals, freeze accounts for security reasons, or impose weekend and holiday processing delays. To ensure your emergency fund works as intended, conduct a biannual liquidity stress test. Attempt to transfer or withdraw a portion of Tier 2 funds to Tier 1, or simulate an emergency withdrawal. This audit exposes any system delays, verifies account access, and ensures that in a real emergency, you can access cash quickly without disruption. Knowing exactly how fast and efficiently you can mobilize funds reduces stress, increases confidence, and guarantees the reliability of your safety net. 4. Establish an opportunity cost cap. While having a large cash buffer can feel secure, excessive accumulation beyond 6 months of survival expenses can limit long-term wealth growth. Every dollar sitting idle in a low-yield account is money that could have been invested to grow. Establish a strict opportunity cost cap for your emergency fund, typically 6 months of essential expenses. Any additional funds beyond this cap should automatically flow into productive assets, such as index funds, real estate, or business investments. This rule prevents fear from paralyzing your financial strategy and ensures that your money is actively working for you instead of stagnating. It balances safety with growth, allowing for both security and wealth compounding over time. 5. Enforce a replenishment tax protocol. Even with a properly funded emergency account, there will be occasions when dipping into it is unavoidable. The key to maintaining discipline in these situations is immediate replenishment. Any withdrawal from your emergency fund should be treated as a top priority financial obligation, not as discretionary spending. Once an emergency has been addressed, pause all non-essential expenditures and direct all available surplus funds toward restoring the emergency account to its full, intended level as quickly as possible. This self-imposed protocol reinforces the protective value of the safety net, ensuring that it remains ready for the next unforeseen event and preventing small emergencies from eroding long-term financial security. For example, If you need to use emergency funds for an urgent car repair, immediately reviewing your budget and redirecting leftover income or windfalls, such as bonuses, tax refunds, or side income, can quickly restore the fund. Over time, this approach conditions your financial behavior, creating an automatic habit of prioritizing liquidity and resilience over discretionary spending. Consistently replenishing the fund trains both discipline and foresight, allowing you to respond calmly to future emergencies without stress or panic. It also builds confidence in your financial planning, knowing that the safety net will continue to function as intended. This ongoing reinforcement fosters long-term financial resilience, reduces vulnerability to repeated financial shocks, and ensures that your emergency fund remains a reliable foundation for sustainable wealth growth and stability. 6. Keep your emergency fund separate from daily accounts. A common mistake is storing emergency savings in the same account used for daily transactions. This increases the temptation to spend the funds and reduces mental clarity about what money is truly reserved for emergencies. Keep Tier 1 and Tier 2 funds and accounts separate from your primary checking or debit accounts. High-yield savings accounts, money market accounts, or treasury-backed accounts are ideal because they maintain liquidity, provide minimal risk, and ensure you are less likely to dip into your safety net for non-emergency spending. Physical separation, coupled with clear mental rules, strengthens discipline and reinforces the psychological boundary between everyday money and emergency reserves. 7. Define what truly counts as an emergency. Financial discipline also involves clearly defining the circumstances that justify using your emergency fund. Many people mistakenly view the fund as a general-purpose account, which can lead to unnecessary depletion and reduced protection. True emergencies are typically events beyond your control that require immediate financial response, such as sudden job loss, unexpected medical expenses, major home or car repairs, or urgent travel for family crises. These situations are unpredictable and can have a significant financial impact if you are unprepared. Using your emergency fund for discretionary purchases, such as vacation, electronics, dining out, or non-essential lifestyle upgrades, erodes the safety net you work to build and undermines your long-term financial stability. Establishing clear, written criteria for what constitutes an emergency is a critical step in maintaining discipline. This can include creating a list of approved situations, such as health care bills, urgent household repairs, or short-term unemployment, and specifying what does not qualify. Mentally rehearsing scenarios helps reinforce appropriate decision-making, allowing you to react calmly and rationally when emergencies occur rather than impulsively spending on non-essential items. For example, if a car breaks down and is essential for commuting to work, using emergency funds to pay for repairs is appropriate. However, purchasing a new car for luxury or convenience purposes would not be justified. Similarly, if a family member suddenly requires travel assistance for a critical situation, the emergency fund can be used without hesitation. By setting clear boundaries and documenting examples, you train yourself to respect the purpose of the fund. This approach reduces emotional spending, fosters long-term discipline, and ensures that the safety net is preserved precisely for the times it is most needed. Over time, this habit strengthens your financial resilience, providing confidence and peace of mind that you can navigate unexpected financial shocks without derailing your broader wealth-building goals. 8. Build your fund quickly with targeted strategies. Many people delay building an emergency fund because it feels slow or burdensome. To accelerate accumulation, focus on high-impact strategies. Automate transfers on payday. Redirect windfalls such as bonuses or tax refunds, and temporarily reduce discretionary spending to prioritize savings. Consider side income streams, selling and use assets, or monetizing skills to funnel additional cash into your emergency fund. The combination of automation, extra cash flow, and discipline allocation can build a fully funded safety net far faster than passive approaches, ensuring that your financial shield is robust, reliable, and ready for any eventuality. So, there you have it. 9 rules for building a resilient emergency fund that protects you from unforeseen expenses while preserving and growing your wealth. From tiered structures and survival burn calculations to liquidity stress tests and replenishment protocols, these strategies ensure your safety net is robust, accessible, and disciplined. If you found this video helpful, don't forget to like, share, and subscribe for more actionable financial insights. Thanks for watching, and we'll see you in the next video.